Well, all right. Welcome everyone to this presentation by Wealth Generators of Forex Trading. And we're really excited to be here tonight. I think the Forex market has huge opportunity for the individual that maybe they haven't tapped into. And of course, Forex, is trading currencies, and currencies are a global market. So we're going to talk first just a little bit about what Forex is, the dynamics behind it, and then we'll get into actual discussion of how to trade it and how to make money from it, because ultimately, we've got to generate wealth, and that's what we're all about. So we're going to talk about how Forex can do that for you and for others. And so without any further ado, let me kind of jump in here. We always talk about, whenever we present these, remember that this is without regard to any one person's investment objectives, financial situation, or particular needs. We're not suggesting that you should invest in Forex, but let's learn a little bit more about it, and then you might be able to understand why it could be powerful as an investment opportunity. So Forex is the largest financial market in the world, relatively unfamiliar for many retail traders until the popularization of the internet. That really spurred on a lot of Forex trading. There are more than 2.5 trillion contracts traded daily. FX was primarily big, large financial institutions, multinationals, and hedge funds, and now it has grown to become worldwide. And remember that internationally, Forex has we kind of take it for granted here in the U.S., and I'll talk about why that is. The U.S. dollar is a reservable currency. It's the biggest economy in the world, and so people kind of take for granted the U.S. dollar. We don't worry too much about our currency, but in other areas, you better believe that people in Greece right now are concerned about the euro and the possibility of being kicked out of the Eurozone and having to go back to the drachma as their currency. And they're worried about currency fluctuations and what that means to their purchasing power and so forth. So Forex, we kind of take it for granted here in the U.S., but internationally, if you want to grow internationally as a business, as a financial firm, Forex has huge potential. And, people in Japan and China and Australia, they trade the Forex markets. They want to know more about the currencies, how to hedge out some of their risks so that if their currency starts to deteriorate, how do they how do they protect against that? What are some things they can do? So it has huge opportunity for us at Wealth Generators accordingly. Now, there are four major pairs in the Forex markets, and you'll notice that each one is a combination of the dollar. So the euro dollar, that's one of the pairs. The dollar versus the Japanese yen, the British pound versus the US dollar, and the US dollar versus the Swiss franc. The other three that are still dollar pairs, but that's against the CAD, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Now, there are certain terms that you're going to hear for a variety of different currencies. For example, when we talk about the Australian dollar, we'll say things like the Aussie. That's a nickname. Or if we talk about the New Zealand dollar, we'll call it the Kiwi. Again, it's a nickname. So these currency pairs, those seven major pairs, account for more than 95% of all speculative trading in the financial or in the Forex markets. So dollar pairs are huge. If you're going to trade in the Forex markets, trading dollar pairs is where the most liquidity is and the most action. Now, we can trade some other combos, but we really believe that if you're trading in the Forex markets, you should stick with the most liquid assets. Some people want to branch out and go trade the Chinese yuan and the Singapore dollar, whatever it may be, but just understand that the more liquidity you have, the more safety you have in what you're trading, and it becomes less of a roll of the dice. We don't want it. I've always been kind of amazed at how quickly people are willing to gamble with their capital, and we don't want that. We don't want it to be a gamble. We don't want it to be a roll of the dice and hope to get lucky. We want to put on solid strategies that over time will build profitability. And so I think sticking with the major pairs can do that. We'll touch on that more as we go. Now, this is a global product with no barriers. Let's go in live and take a look at some of these in real time. Now, there are some pros and cons to the Forex market. Some good and some bad, in other words. What's one of the bad aspects, in my opinion? It's also one of the good aspects, I guess, is that currencies trade 24 hours a day, right? They're open at all times. Whoops, we just had somebody's webcam jump up there. All right. That might have been Damien. He was just jumping in to say hello. That was awesome. So in the Forex markets, it's 24 hours a day. So there's always a trading opportunity, but the problem with that is because there's always a trading opportunity, people tend to get involved in these currencies maybe at the wrong times and out of boredom and whatnot. So as a professional currency trader, you're going to want to focus on time periods where you have the best potential. Now, as we look at these currencies, let me show you a few of these. So we have the US dollar pairs up here on the top. Now, the first currency listed in a quote is what you're trading. The second one, well, it's called a base currency and a quote currency. But I want you to focus on the first symbol as being the currency that you're really taking a trade on. So if the US dollar, which is symbol USD, is listed first, you're making a trade based on where you think it's going to go versus the second currency. But you're going to focus on the first. So if I think the dollar's going to go up versus the Canadian dollar, then I would buy this currency. If I think the dollar's going to go down, then I would sell this currency, right? If I think the dollar's going to go down versus the Canadian dollar. Or I could trade the US dollar versus the Swiss franc. So I could put on a trade where I say I think the dollar's going to go up or down versus the Swiss franc. Now, sometimes the US dollar's listed second. It's still a dollar pair, but now you have to think, you're always thinking in terms of the first currency. Where do I think that the British pound, that's GBP, where do I think the British pound is going to trade versus the US dollar? If I think it's going to trade up, I would buy this pair. If I think it's going to trade down, I would sell this pair. The first currency is what you're buying or selling versus the second. Now, that might sound a little bit foreign, but think of it this way. Currencies are simply your purchasing power, right? Now, if you really want to get into the nuts and bolts of it, these are called fiat currencies. They're paper. Now, what is the paper worth? Well, paper is worth, next to nothing, but we think that dollars are worth something or British pounds are worth something because of what it can buy and because other people have confidence in it, right? So I can trade my dollars for British pounds, or I can trade my dollars in for a barrel of oil, or in other words, I can trade my dollars in for gasoline at the pump. I can trade them for other things. It's a currency. As long as people have confidence in it, then it has purchasing power. If people lose confidence in that currency, then it doesn't have value anymore. There's a great story about there have been examples of banana republics where basically the currency deteriorates to the point where it's worthless. There was a big kind of to-do where people were trying to sell Iraqi dinar because when the Iraqi government collapsed, the dinar collapsed and people were trying to say, they'd accumulate all this dinar and then they try to sell them for real capital. Well, that didn't make sense because the dinar was worthless, but people would still pay money going, well, what if it rebounded? I could buy 1,000,000 dinar for $50. Wow, what if it went back to where it was? Well, it wasn't going to do that, right? So it was just kind of, you were buying, paper that was worthless. Well, anyway, there was a gentleman that was just cruising along with his wheelbarrow, and he had a stack of cash that wasn't worth anything because the currency had collapsed, right? But it was just loaded with it, paper, far like 2 times as high as this wheelbarrow. And a couple of guys came running out of this alley basically and hit him in the face as hard as they could. knocked the guy to the ground, dumped out the cash, that worthless currency, and stole his wheelbarrow. True story. So anyway, the wheelbarrow was worth something that worthless currency was not. Well, people worry that what if we lose confidence in these currencies? Well, that's what would make a currency drop. So a lot of what, people worry about is, well, if we keep, uh, you know, things like entitlements, if we don't have enough to pay for Social Security and all of these sorts of things, people will lose faith in the US dollar. And now all of a sudden, as the dollar value goes down, that could create problems. Well, if you want to profit from the dollar going down, you just have to decide which currency is going to be the beneficiary, right? So, yeah, the wheelbarrow got stolen. They didn't want that worthless paper that used to be worth something, right? So if you think that a currency is going to drop to that value where you could have a wheelbarrow full of that currency and the only thing that has any real value is the wheelbarrow, you could profit from that. So if the beneficiary is the euro, or if the euro is going to decline in value but the dollar is going to stay strong, you can take advantage of these trades in the currency market. Now let me show you from the standpoint of a chart. We can track how these currencies are trading on a day-to-day basis. I'm going to turn to a daily chart. Now this represents, let me put some indicators and things on here. So this represents a chart. Let's go back to Euro USD for this. And let's go to the daily time frame. So here is the euro trading versus the dollar on a day-to-day basis. And what do you see? Well, you see that the euro back here in December, remember we're talking about what the first currency was doing versus the second. So the euro was dropping. This is a chart of the euro in value versus the US dollar, and it was dropping violently. And if you look at it on a percentage basis, it went from 1.22 euros to a single dollar. So every euro was worth $1.22 compared to a single US dollar, dropped all the way down here to about $1.06. In other words, it was approaching parity. Parity means that 1 euro is worth 1 US dollar, right? It would be equal. Well, the euro's been dropping in value. So if you've been betting against the euro versus the US dollar, you've been doing quite well. Over the last couple of months, it's just kind of stabilized here and bounced up a bit. Now, as traders, you have to understand that we can take advantage of all of these moves. And a currency trader, there's a few different ways you could do it. You could take big long-term trades, but most traders are going to look at, in the currency market, opportunities to take quick in and out style trades, quick in and out positions, because currency is very, very leveraged. You can get 40 to 1, 33 to 1 type of leverage on your currencies. And this is part of the benefit. So if you find someone that says, I can't invest in stocks. Stocks are expensive. I don't have thousands of dollars to put into a stock and own it, or whatever. Well, in the currency market, you don't need that. People will trade currencies with $1,000 total because if you have 40 to 1 leverage, your $1,000 position is actually controlling $33,000 or $40,000 worth of the currency, right? If it's 33 to 1 leverage, $1,000 will control $33,000 worth of it. Or if it's 40 to 1, $1,000 controls $40,000 of the currency. And then on top of that, we can manage our risk. So if I come into an hourly chart, I'll give you an example of a trade setup. Let me just see if I, have anything. Let's go through a couple of these. Here's the US dollar versus the Japanese yen. And this one might give us an example. Well, actually, there's a line already drawn here. This is a perfect example. I already had it on here from the past. This was a trading opportunity. I had already identified a resistance, and this line was already on there because that was a buy point. So here's the dollar versus the Japanese yen, and it was breaking out to the upside. So if I buy right there, and you can see I already had it highlighted, but if I buy right there, I'm buying at 123. Let's drag a line over here and just kind of get an idea. we're buying at maybe 123, pretty close to where it is right now, right? But this trade, this big bursting move, you have to understand that's worth a lot of money. Doesn't seem like that much, but that's a big move in terms of pips. Every penny here, so if it goes from 123.87 to 123.88, that's called a pip in currency trading. So every pip on a full lot position would be worth about $10. Okay, so in other words, if I bought a full lot, a full sized position here, and it went up, I mean, this thing went in a straight line over the next few hours. You can see it went from 123, 80 to 124 and change. Let's just say it went up 40 pips. If we make money on, it went up more than that, but I'm not going to guess that you sold perfectly at the top, right? We didn't do that. We probably sold down here somewhere. We're not perfect by any means, but if you made that little 40 pip move, well, 40 pips at $10 a piece, that's $400 a profit in a few hours, right? Now, what if this trade hadn't worked? People ask that oftentimes. This is your breakout point, so where are you going to put your stop loss? Now, a stop loss is an automatic exit order, so you'd put your stop loss below the breakout zone, right? You'd put it down here. Whoops. So that if we didn't hold the breakout, if it had fallen back, it would have kicked you out automatically. Now, would you have taken a loss on that trade? Absolutely. If you had bought in here at 123.80 and stopped out here at 123.70, that's 10 pips at $10 a piece. That's $100. But you can see the risk to reward. If this trade hadn't worked, we lose 100. If it did work, we make 400. That's good risk to reward, right? And so this is trading kind of in a nutshell. Of course, we would have education behind any trading instrument that we're going to utilize at Wealth Generators. So if we put on a Forex program, we're going to have education where people can get in there and go, you know what? I actually understand how these things work, right? I understand the dynamics. And so if it feels like, wait a second, he's talking about pips and, buy here and sell there, I'm not following everything, don't worry about that. We're just talking about the basic concepts of why the Forex markets can be very, very advantageous. And we would put educational curriculum around it as a tradable instrument. Now, as you travel worldwide, as I said before, people in Australia, people in Germany, they focus on currencies, they trade currencies. It's the largest financial global market out there, and it's an untapped resource thus far at Wealth Generators. We're excited to, we're excited to hear from you all about this product and what you think about it. I think, obviously there's huge tradable opportunities and great for leveraged opportunities where you don't have to risk a lot. You don't have to trade a full lot, in other words. You could be risking $25 to make $100, right? You can trade it in different sizes. You can manage this risk to what's appropriate for your trading account. And some people say, well, I'd be willing to risk $300 to make, $1,200. It's the same principles. It's just, am I trading a bigger position size or a little smaller position size? So huge opportunity. Now let's go back to our currency board here. A lot of people ask, well, when you said early on that we shouldn't be trading it at all times and in all places and so forth. When should we be trading this? Let me show you a cool website. This is called forexfactory.com. So you can keep that in your notes. forexfactory.com. And this is a free website that has a lot of Forex knowledge and calendars and just different things that professional traders will utilize. So if I come into forexfactory.com, right at the very front page is a calendar for today. If I want to see tomorrow, I just click to tomorrow. If I want to see next week, I'd come up here and hit the calendar, and simply choose the date that I want to look at. So if I want to know what's going to happen, next Friday, this is not this coming, but the following, July 3rd, what's on tap, and it'll tell me the news events. Now let me show you how really powerful and cool this is. Let's go back to today's date. One of the things that pushes currencies is, of course, news. So do you think it matters if the Federal Reserve is holding a meeting, an FOMC meeting, to the US dollar? Well, of course it does, because the Federal Reserve controls, interest rates, and interest rates have an impact on currencies and so forth. So they're linked. So these news stories that come out at all different hours of the day and night, we know that Forex trades 24 hours a day, but we don't have to be trading it all day long. That's the point. You shouldn't be trading it all day long, but there are certain events that are key around certain currencies. And so this calendar will show you, okay, the euro is going to be impacted at 3 a.m. I guess that's already passed because that was this morning. That was early this morning, right? French PMI. You see how it's red right here? Red means it has a greater impact. Orange means not so impactful, right? Yellow means not at all. So you can focus on the red and kind of see what the big news events are. So, this is tonight and so forth. So we're here on Tuesday night. Let's see. We do have a China number. CNY stands for China, but it's not very impactful. And that's out in 14 minutes, it looks like, at 10 p.m. Eastern time. So let's look at tomorrow. We don't have anything for the rest of today, but in the morning, remember this is 4 o'clock a.m. Eastern time. So in the middle of the night here in the U.S., the euro is going to be moving on some German news. There's also Eurogroup meetings all day tomorrow. We get GDP data out of the U.S. tomorrow morning, 8:30 a.m. Eastern time. The U.S. dollar is going to be moving. Okay? Those are your impactful events. So here's where people make a mistake. Because the currency markets are always open 24 hours a day, well, they're not always open. They do close for the weekend. Okay? So they actually will close at Friday afternoon after the markets close, and then they reopen Sunday afternoon. So they do take the weekends off. There's also a little 15-minute window where the currencies will stop trading after the closing bell every day. But for all intents and purposes, all you need to know is they're pretty much open 24 hours a day, Monday through Friday. Okay? Pretty simple. But this is when, these are the events that are going to drive those currencies. So you don't really want to be involved when there's not energy in the market. Now, so when we look at, the GDP data tomorrow morning out of the U.S., it's going to be impactful to the U.S. dollar. And what professional traders will do is they'll focus on a few events every week that are going to have some impact, and they'll look to place their trades around those. Right? So we could place a trade where if the dollar starts to break out, our trade automatically triggers and gets us in. And not only that, with technology the way it is, we could have it trigger and automatically have our stop loss and our target all in one order. We could literally put an order out there that says, do everything for me. If it breaks out above resistance, I want to buy, and I also want to stop, and I also want to target. And it's actually very simple to do. Let me show you what I mean. Let's say we were going to trade this US dollar position tomorrow on the GDP data. If we were going to do that, we'd have to figure out which dollar pair we want to trade. Do we want to trade it versus the Canadian dollar, the Swiss franc, the British pound, the Australian dollar, the euro, the Kiwi, or the yen? Right? We've got to pick the pair. The idea in currencies is to figure out which one's going to be strong and which one's going to be weak. So we have ways of analyzing that. Relative strength, relative weakness, what we've been seeing in their trends and so forth. But let's just hypothetically say that we think the dollar's going to be strong and we think that the Swiss franc is going to be weak. Okay? So here's our pair. If we thought that this pair was going to be the pair to trade, If we think the dollar's going to be strong, what are we going to do? We're simply going to buy that pair. So I'm going to click to set up a buy order. Okay. Now I can attach to that order by right-clicking. Remember, I haven't sent any orders. I'm just building trades. But I could right-click and hit bracket orders. And you know what this does? It allows me to put in prices where I want to sell above. So something like, this. And a stop loss that will protect me below. Now let me show you what this looks like. Something like this. Okay? Let me show you what this looks like on a chart. Whoops. Let me fix that. It messed up our... There we go. So here's our chart. Now here's essentially what we're doing. Let me come in here and kind of explain. We've built a trade that says I want to buy, I want to sell up here, but in case I'm wrong, I want to sell down here. Literally, we have put out an order that will take care of itself, and we can have great reward to risk ratios. We could say I want to sell twice as high as where I'm going to sell down here. So if I'm wrong, I lose 1. If I'm right, I make 2 or 3 times the amount, right? And this can be essentially automated. I'm just showing you from a chart where you could put your target order up here, you could put your stop loss down here, and you could have your entry price right in here. Now, as you look at that, as you come in here, it's just simply putting in your order prices. It might feel a little bit complex, but trust me, you'll set up a demo account before you ever live trade. And a demo account just allows you to kind of practice putting in a couple of numbers, getting familiar with how it works, that sort of thing. And once you have your prices, you just say, okay, I want to buy. You plug in your price. Anyone can follow instructions. Okay, if I want to buy at this price, I'm going to put a sell limit above. I'm going to put a sell stop below. Then you just simply hit the transmit button, and away that trade goes. And it would have that risk to reward. And there are ways to double check your work and make sure you're doing it properly and so forth. But really, nice technology that just kind of gives you the opportunity to profit from these currency moves, right? So the Forex Factory is a good place to go to just to be aware of what's moving the markets at what different times and how can we take advantage of it. And you can play around with the calendar. There are some other things here, but I would say most traders focus on the calendar. Now, if you wanted to dig into the fundamentals, we could actually click on the folder and it would give us an explanation. And it would say something like, here's the way it trades. If the actual number is greater than the forecast, that's usually good for the currency. Well, if you think about it logically, if the U.S. reports a strong GDP number, that's gross domestic product, meaning simply that the U.S. economy is growing, that's good for the dollar, okay? And that's pretty simple to understand. When your economy's doing well, people have more confidence in your currency, and thus it becomes a stronger currency, right? So the downside is if your if your economy starts to collapse, then people lose faith in your economy and in your currency, then the currency's value starts to collapse, right? It works the opposite way. Great questions that have come in. So would the trade alerts have step-by-step places? Yes. Not only would it have step-by-step instructions, it would have the actual order ticket, exactly what it looks like, right? So in other words, when you come in here, you're not flying blind. If we say, again, let's say we wanted to buy the British pound versus the Japanese yen, then the trade alert would say buy JPY. So you'd come in and you'd find that currency first. And then it says buy. Okay, we'd click a buy order. So we'd show you how to do that. And then it would say buy at 194.85. So you simply plug in the number 194.85. And it would also have a video that would show you the process, right? So even if you hadn't been trained previously, you could follow the video. Of course, we always emphasize nobody should be doing this without practicing. If you're going to make any mistakes, do it in a demo account before you go live. And it makes sense just to practice anything before you actually do it. You would probably not want to join a cooking competition unless you'd practice cooking that thing a couple of times at home, right? You're probably not going to deliver cookies around the neighborhood unless you've practiced maybe baking them once or twice. So you're not going to put your real money into the markets unless you've practiced placing the trade a couple of times. But yeah, it would have all of those details. Is this like binary trading with less of a gamble since we're getting the guidance of trade alerts? Well, so binary options work a little differently. That might be a little bit beyond the scope of what we're going to cover here, but to make a long story short, a binary option is basically you could pick what time period and what asset is going to be at what point in time. So it's just like, if I thought gold was going to be above 1200 by tomorrow at 10 o'clock a.m. Eastern time, well, I could place a trade that takes advantage of that. This works a little different where binaries are just, it'll either be above or below, and you either make the money or you lose the money. These currencies would work a little differently in that we would cut losses still. So they work like binaries in that we will always want to limit our downside. See, professional traders, we hate stop losses, but it's a lot better than the alternative. So do I like to get stopped out? Well, no. Stopping out means, if it hits my stop loss down here, that means I lost some money, right? But what's the benefit? Why do professionals always use a stop? Because the downside is if I don't have a protection order in place, it could just keep falling and falling and falling. So every buy order comes with a stop loss. This is the way I trade Forex. No exceptions, no excuses. I know exactly how much I'm risking right when I get into the trade every time. And I won't do it without a stop loss, okay? But here's the thing, we don't always have an order to sell up above because none of you would go outside your front door with a pair of scissors and cut all your flowers and then just let the weeds grow and grow and grow, right? You wouldn't do it. Doesn't make any sense. Well, we don't want to do that in Forex. We don't want to cut all of our good trades off quickly. We want to let them grow. See, a good trade is a flower. A bad trade is a weed. Let's get rid of the weeds quickly. Let's let the flowers bloom. What ends up happening is you'll get some runners in the Forex market that will run 100 and then 200 pips. And all of a sudden, you're making an awful lot of money. So you've got to let those winners run and you've got to cut the losses. So we weed our garden. We get rid of the weeds. We let the flowers bloom. And trust me when I say that is a great way to trade because your rewards come very, very big and your losses come very, very small, and that's a good combination to have. So, yeah, with a stop loss, you don't have to keep your eye on it, although, you would still want to just simply, well, there's passive or there's active management. Passive management would just be having another sell order above. That's very passive. If you have a sell order on both sides, well, then you don't really need to watch it. It's just a race to one side or the other. But when we don't have a target sell order, then we monitor it. And then we would send alerts and say, hey, we're going to go ahead and get out of this. It's run 150 pips in our favor. We've got a huge profit. Time to go. That sort of thing. So, Will Options House have this type of trading, or would it be with a different account with a different company? Um, that's a good question. It would probably be, though, with, Options House is really an option trading firm. This would probably be with what you're looking at here is a broker called Interactive Brokers. I don't know if we'll go with them, but 85% of the global markets, they have data that just shows that they have their hands in everything. So I don't know for sure the process there, but you'd probably have a separate Forex account. And like I said, I mean, because of the leverage, it could be a $2,000 account, $1,000 position size. It doesn't have to be a large amount of money by any means. Okay. Let me see here. Damien had a question. And I have to say, the questions are fantastic and on point. So thank you. So great question. How are the trade alerts going to work? It seems like you have to really keep an eye on this with how constantly it's changing. It feels like it's constantly changing, but remember, this is, since we've been here, just to put it into perspective, let's think about how long we've been in this class. Okay, this is an hourly chart. So if you really hone in here, let me zoom in. It feels like there's a lot going on, but here's the reality. In the past 6 hours, 1, 2, 3, 4, 5, 6, this thing has moved about 13 pips is all, okay, in 6 hours. Now, you wouldn't really want to be trading in this period of time. Why? Because it doesn't have energy, right? We would focus our timing, our strategies around catalysts. So it would be like every week we would highlight the events that we want to trade. I'll give you a good example. So this week's not a big one, but let's go to next week. Let's say, how would we plan out our week next week? Well, we wouldn't trade on Monday. We certainly could be possibly trading the British pound in the middle of the night. But one thing you'll notice, GDP numbers are not actually as important as this thing says. Now, here's a good one. China's reporting manufacturing PMI at 9 o'clock p.m. Eastern Time on Tuesday of next week, so exactly 1 week from now. So that's 9 p.m. Eastern Time. And China, typically the currency most related to China is the Australian dollar. It's a big trading partner. They're resource rich, and China's been really a consumer of commodities. So the Australian dollar moves on those events. And we really have a Chinese number followed by a Chinese number. We get manufacturing PMI at 9, and then we get HSBC final at 9:45. So those would be a time where I'd actually be looking to trade the Australian dollar. So what we would do every week is say, hey, for this week, be prepared around 9 p.m. on Tuesday. Let's keep going. And there would just be a couple of trading opportunities per week. ADP, not huge. ISM, not huge. Let's keep going. Now, here we're talking. So Thursday, and this is a little bit weird because usually the non-farm payrolls, this is the unemployment data here in the U.S. Usually it's on Fridays, but guess what? The markets are closed on Fridays for the 4th of July. 4th of July is on Saturday, but the markets close on Friday in observance. So that pushes these economic results forward to Thursday, and the non-farm payrolls, that unemployment data, is coming out at 8:30 a.m. Eastern Time. So here's what we would do. We'd say, here's your schedule. Be ready on Tuesday at 9 p.m. Eastern Time, and be ready around Thursday at 8:30 a.m. Eastern Time for a couple of trading opportunities. And how cool is that, right? You can pick, you could be at both of them. You could be at one or the other. You could be ready for alerts. You could be, aware of what's happening and taking advantage of these opportunities, right? And so is it time consuming? Absolutely not. Trade for an hour, couple hours on Tuesday or on whatever it was, Monday night, or no, it was Tuesday night, and then Thursday morning, you're done for the week. We hopefully have a nice big positive pip count, and that's kind of the idea behind it. And that's how you should trade. You really shouldn't be involved in the financial markets, well, in Forex specifically, on all of those, quiet periods, because to try and predict what what the British pound is going to do versus the Japanese yen over the past 6 to 7 hours, I mean, anybody's guess, right? We have no way of knowing. There's no catalyst. But if there was a Japanese data point or a British pound data point, something out of the UK, well, now all of a sudden we could play a momentum move. So if it started to break out to the upside, we could be buyers of that move. Or like back here, when it started to break down, we could be sellers of that if there was a catalyst driving that move and profit from that over the next couple of hours and be done for the day. That's really the route we would go. Would wealth generators recommend a brokerage firm? I think that we would absolutely positively emphasize what we believe in, which means at the end of the day, we only want to be associated with a brokerage firm that is top notch. So there are Forex trading has had a bad reputation in the past. And the reason it's had a bad reputation in the past is simply because in Forex trading, there have been some rogue brokerage firms. And these are small mom and pop shops, but these were people that, didn't do things the right way and tried to set up a brokerage account and blew up and hurt people. And, you don't want to be with that. You want to be with someone like, whether it's Interactive Brokers or someone else, it could be City Financial, it could be maybe even FXCM. That's a big major brokerage firm that trades Forex. There are a few out there that are big names, huge liquidity, big financial backing, and you just don't have to worry about, whether they're ripping you off on spreads and things like that. Like Interactive Brokers, as an example, they don't make money off of your spreads like a lot of those mom and pop shops do. So there's a reason why the big boys use these big liquid online brokers that are big financial institutions. Interactive Brokers is a publicly traded company, massive corporation and so forth. And like I said, has access to all of the primary dealers, will get you the best price executions and things like that. So we're going to emphasize at least, at minimum, things that will protect you. That I hope goes without saying, because we don't want you with any brokerages that are on the fringe, that are kind of, here today, gone tomorrow type of scenario. No. You want to be with the big firms that have staying capacity. That's my belief anyway. I gave an example of the differences between brokerages. Some will trade. This is called the spread. It's just the difference between the bid and ask prices. Interactive Brokers, because they deal with all the major dealers, they have tight bid-ask spreads. Here it's like 1 pip difference. That means you can get in and out easy and cost effectively. But with others, they could widen out that where you're literally trading with them. Like if you want to trade the pair, you have to pay their prices. And so what they do is kind of become a bookie system where they're trying to get buyers over here and sellers over here with their firm. But because they keep these big wide spreads and you can only trade with them, you're getting ripped off every time you get in or out. Essentially, you're paying the casino a big premium, and you don't want that. You don't want to be betting. You don't want to be with the casino. Be with the real legitimate broker. That's the point. You don't want to see these massive spreads, and you don't want to get ripped off every time you get into and out of a trade. That's ridiculous. So, that's I think a very, very important point. Like I said, the questions have been fantastic and very on point to what we're talking about here. So, So good question. Would we be trading on the 1 hour or 4 hour daily charts? My personal preference is trading on the hourly chart. That's going to be my favorite. You'll notice I pulled that up quite often. You might look at, a daily chart to get kind of a feel for trends and momentum, but I prefer to trade on the hourly. All right. Well, I hope this was really helpful. I realized there was a small technical glitch, but we've made a backup recording. We're making sure that, we'll get this information out so that other people can view it and share it and do things like that. As always, as we said from the start, when you're trading, remember a few important points. We're not giving personal investment advice in that, we can't tell you what's right for your personal situation. Everybody has different amounts of capital. We can't tell you that you should trade this position size or that position size. Number one, we're not licensed to do it. We're not your individual financial advisor, right? We're giving information to the masses. So it's very important that you do your homework and think through the process of, okay, how much am I willing to risk? How much am I really willing to put into each trade and, make smart decisions for your own personal situation. Because it doesn't make sense for somebody, to trade like somebody else when they have entirely different scenarios. Some guy that's a millionaire and some kid fresh out of college that maybe doesn't have as much money could be in an entirely different situation as far as how they're managing their money and how big a position sizes they're putting on and so forth. So we would structure some education around that, but just remember, you're responsible for putting on your trades, your position sizes. So learn what you need to learn before you ever go live in the financial markets. Very, I think, important, but needs to be said. We'll keep you updated. I think Forex has huge potential for growth. Like I said, it worldwide, it just is a massive market and has great potential. So I know that there are, frankly, the Forex trading markets. There are housewives in Hong Kong that trade it regularly. There are, janitors in Colombia or whatever. I mean, it's worldwide, and it doesn't care about your personal situation, your job situation and so forth. It gives you the opportunity to trade some capital, have a little leverage behind it. You need to do that responsibly, but if you do, there could be great potential with it. So thanks again, everyone. I hope you've enjoyed it. We will see you all next time, and if you have any additional questions, let us know. Thanks again. See you next time.